Gas prices just surged over 20% in a single month. Inflation is rising again. Inside the Fed, we're seeing the deepest divide in decades. So here's the question. Is the soft landing still alive? Or are we watching it quietly break in real time? Hello, everyone. I'm Advisor Andy, and this is Inspired Money, where we break down the biggest shifts shaping your money, markets, and the economy without the noise. Right now, the Federal Reserve is stuck. They've paused rates, but inflation is reaccelerating. They're trying to protect the economy, but the job market is starting to crack. And beneath the surface, the consensus is gone. This isn't just policy anymore. This is pressure building across the entire system. Today, we're going to talk about the Fed and, more importantly, what it means to our money. And at the top of the hour, we will be joined by networking expert Kelly Hoey. We're going to shift from macroeconomics to personal leverage and dig into her new book, Social Billionaire, a networking roadmap that can empower us in uncertain times. So stick with us. But first, a word from our sponsor. This episode is brought to you by my company, Runnymede Capital Management. Here's the reality right now. Household budgets are under pressure. Gas prices are moving higher, grocery costs are still elevated, and even as the economy sends mixed signals, most people are feeling it in their day-to-day spending. I have to say that the last time I went to Costco for gas, the line was pretty long. And the challenge is most financial plans don't reflect that kind of change in real time. And that's why we built a simple starting point. In just 3 minutes, you can get a personalized financial snapshot that shows how current conditions may be impacting your plan, cash flow, savings capacity, and key pressure points. And if it makes sense, you'll have the option to review it with me directly so we can walk through it together. Get your free 3-minute financial plan at inspiredmoney.fm/getplan. Now let's bring in our panel of experts. We're joined by Mike Taylor, Mike T, lead portfolio manager of the Pink Simplify Healthcare ETF. He was formerly a top-performing hedge fund manager at Citadel and Millennium with over 2 decades of experience navigating complex markets. Mike, welcome back.
Thank you so much for having me.
We have Gary Brode, who I don't know how he's still awake. He is managing partner at Deep Knowledge Investing. He brings 30 plus years of experience across firms like Morgan Stanley and Brahmin Capital, delivering independent, high conviction market insights. But he spent, I don't know how long, the last 19 plus hours on an airplane coming back from Asia. He got 90 minutes of sleep last night. Gary, are you awake?
Yeah, somehow managing. And Andy, thanks so much for having me on. Always great to be on with you.
We're so curious to see what's going to come out of Gary's mouth because maybe he has no filter since his brain is sleeping. Rounding out our panel today, we have Dr. Kruti Lehenbauer, economist and founder of Analytics TX, with over 25 years of experience in economic analysis and data science, specializing in turning complex data into clear, actionable decisions. Kruti, welcome to Inspired Money.
I'm very happy to be here. Thank you so much for having me on. I'm looking forward to this discussion.
I think we're going to have a blast. We're going to make the topic of the Fed and interest rates hopefully applicable to people's lives and that they come away with this realizing how important interest rate policy is, not only in their day-to-day, but to the stock market and to so many other aspects of our lives. Let's begin the discussion with segment 1.
Look at the voting block. The Fed held rates at 3.5 to 3.75%, but the consensus is dead. We are seeing an 8-4 split, the deepest level of internal friction since October 1992. The Fed isn't just fighting old ghosts. Headline CPI has reaccelerated to 3.3%, fueled by a staggering 21.2% monthly spike in gasoline, the steepest jump since data began in 1967. This is a geopolitical inflation impulse that Powell cannot control with domestic interest rates. Is the soft landing officially moving from a goal to a ghost story?
Gary, when you see inflation reaccelerating like this, especially driven by energy, does the soft landing still feel realistic to you?
So, Andy, first of all, in the lead up, there was that question about the lack of consensus. And I just want to address that first. I actually think it's a great thing. We keep seeing all of these stories. Oh my God, 2 Fed governors dissented, 3 dissented, and this is somehow a bad thing. My view is if everyone on the Fed always agrees, then we don't need 19 of them. If the job actually requires thought and analysis, then shouldn't there be regular disagreements? Beyond that, regarding a soft landing, the newspapers always point to the most recent thing. Right now, what we're hearing about are tariffs and war-related oil prices. But, before that, it was COVID and supply lines and the boogeyman and Putin. There's always an excuse. Real inflation is being caused by overspending in Congress. The original definition of inflation was an expansion of the money supply. And it's this overspending that's causing this. Look, I'm on team N the Fed. I'm always going to be there. But this issue isn't their fault and they can't fix it. M2 right now is running up 5%, and the price-based inflation indexes are actually lagging that. So, people are looking right now and saying, oh no, inflation's 3.5%. Now, I actually think that's a bad thing, but it has nothing to do with the Fed, and it's going to continue until Congress stops overspending, which is never going to happen. So get comfortable with it. We can be happy or unhappy, but the only thing we can do is prepare our portfolios for it.
Mike, do you recall periods where input costs hit this quickly? And how did management teams react? Who handled it well versus poorly?
Well, you don't have many instances of where the input costs, especially certain sectors in petroleum and plastics inputs, things like that in Europe and Asia, have moved extremely quickly. I can't recall at least a time in my lifetime where this strait has been shut before. So actually navigating it is going to be very, very challenging, especially for companies that just don't hedge. So yeah, I do concur with your previous commentary on ending the Fed. We're in a remarkable moment. We'll talk a whole lot about that in a little bit.
Do you foresee a time when there is no Fed?
No. But
Okay.
I mean, these are high hopes. I also hope to meet Santa in person one day. So,
Kruti, when you look at CPI reaccelerating, how do you separate what is the real signal versus what could just be noise in the data?
I just look at I look at months and weeks and years of data whenever I see a spike, and then I do a relative comparison. I know that a lot of people do a 2-month lag, 3-month lag, but when it comes to things like interest rates and CPI, sometimes you have to look at 12-month and 18-month lags. And that is the part that, like Gary and Mike both said, the media doesn't focus on those long-term impacts. Because when you look at the long-term trends, you realize that it's not that big of a deal. It could seem like a spike, but a lot of it is noise, and a lot of it is very obvious on why it's happening. Like when the PCEs and the CPIs are so heavily dependent on energy prices, a spike in petroleum is going to seem to be far worse than it really is. So,
Mike, you're on Twitter a lot. Tell people why interest rates are so important.
oh, it's everything. And look, this is a remarkable moment, what's occurred. And I honestly thought that it was going to happen now and now-ish towards the end of the decade. And that is the demographics impacting the way governments spend. We're seeing a lot of spending worldwide in industrialized markets, so Europe, Asia, US, in order to make the ends meet. Population is in decline. In many places, it's abject decline. Otherwise, it's just the working population versus the older population.
mm-hmm.
But no matter what, for instance, in Asia or Southern Europe, most of Europe, US is a little bit better. If you open a restaurant today with 100 tables and you're 30 years old, at the end of your career in 30 years, you're 60 years old, I promise you, you will only be able to fill 70 of those 100 tables. So how do you model for that? How do you borrow money to start a restaurant when the population is going to drop by 1/3 over the next 30 years? How do you do that? How do you ever pay that debt back? That's where we are. This is why it's happening, is that the government is stepping in to make it so that we have positive GDP growth, because the aggregate demand is going to be negative and accelerate from here. It started in 2019. I didn't realize it at the time. I thought it was just kind of just crazy spending, but no, they were actually spending to make that GDP positive and keep us on our growth trajectory, keep winning elections. And now it's turned into a gigantic debt bomb. And hence, it costs more to finance that debt. And this is why I expect us to have serial money printing for the rest of my adult life. And hopefully that'll be 200 years. But I don't see an exit for at least 50 years. And we're probably going to have, I mean, you're going to see next year a really, really big problem happening in Europe because of this, whereas certain countries can't print their way. They don't own the printing press, and specifically France. And we're going to see huge problems starting next year between busted elections that go the wrong way, a demand for more money politically, but you can't get it. And here you can. In fact, we're already printing money again. We have QE going on right now, whether it's through a reverse repo, now printing $400 billion on the short end of the yield curve. And what we're very likely going to see, in my humble opinion, is moving forward, we're going to see really strange, gigantic swap lines to essentially extend free credit to OUS nations so they can turn around and buy US dollar assets. That'll be the next leg in my view. So it is so complicated as to what's going on now. They're spinning so many plates, but it all comes down to family unit formation and making babies. And we're not doing it. I suspect it's because the taxes are too high, and that has actually ruined the family unit. And families are smaller and smaller, and kids, quote unquote, cost a heck of a lot more. It's just that we're simply taxed to death. That's my 2 cents on the matter. There's probably a dozen issues, but long story short, that's the problem with rates. The federal government around the world has basically taken out the private markets by sucking out all the demand for this paper that has to come to market. It has forced the long end of the yield curve to go up, and it is no longer a safe asset. Heck, Johnson & Johnson is a safer asset than the US Treasury, and it's priced as such.
Kruti, what's your reaction to the scenario that Mike just outlined?
You know, while we were talking about having these dreams of things that we would like to do, like meet Santa, have no Fed, my dream would be to have a very minimal government alongside a no Fed. Because if they stopped spending like idiots, I think a lot, oh, did I just say that out loud? But I think that could solve 80% of our problems, because when we take the power away from local governments to decide what matters and what doesn't, and put it all at the central level, we are creating disequilibrium under the guise of good intentions. And we all know that good intentions and good outcomes are not the same thing. So I agree with what Michael said. And like I said, I take it one step further. Let's take the government spending out, because that is the worst way to increase GDP in the long run. In the long run, the only way the GDP can grow is if the aggregate supply grows. The only way aggregate supply grows is if resources grow, if labor is allowed to do its job instead of being cut off because there's a $15 minimum wage. And if you are willing to work for less than that, then you're just worthless. So,
Gary, how important is interest rate policy to your investment approach?
Completely irrelevant. In 2022, I made a lot of money shorting the market, and it mattered then. At this point, there's nothing the Fed can do to fix that. And this is something, we've talked about a lot. The Fed is really trapped. And, I don't want to get too much into things you want to discuss later. I would love to address some of the things that Mike and Kruti said, though, if you don't mind. First of all, Kruti amplified my end the Fed point with close the government. So she's my hero of the day. I also think Mike made a fantastic point about GDP. It is a fiction. It's all a waste. the people have this fiction, this perception that GDP represents the productive part of our economy. It does not. Our government basically prints money, spends it, wastes it. A lot of that spending has a negative impact, but it's all counted as GDP. So basically, the GDP, if the GDP is the government report card, they get to determine their final grade just by printing, and we're all suffering from that. And the issue is, and Mike got into this, and I think it really matters, is that response, that policy response from the government is killing our birth rates in the middle class. It's all a giant Ponzi scheme. And the answer to that isn't to change the country. It's to fix the reason we're not having kids and starting families. The amount of government waste is crushing the middle class, and it does make its way into taxes. But even worse than that, it makes its way into just permanently higher prices. And then, somebody was just talking, I think Mike was talking about the risk-free rate, and Andy, you were asking about interest rates. I would just add that the risk-free rate is also a fiction, because when they say risk-free, they say, well, the government can print money. You're guaranteed to get your money back. And that's 100% true, but you're going to get it back with less purchasing power. It's being stolen from you. It's being stolen from all of us. And that is a gigantic problem. And what's really hard is we live in a society where people don't get a financial or economic education. And to the extent that they do, it's almost always Keynesian nonsense. But people don't understand the link between the things that Mike and Kruti were talking about and government overspending and the addition of all of this waste and our reduction in birth rates and family formation. They are 100% tied.
Very interesting to think about what Mike said. I think developed nations, for sure, it's a demographic problem. You're having fewer babies, and then the question is, how do you spur growth? And governments are lowering interest rates to do that. In the work that I do, my father gave me a framework. We do look at monetary policy. We look at economic data. We look at the technicals, price data of stocks, and we look at valuation. And the monetary aspect, we always say that monetary policy, if you have low interest rates, you're increasing liquidity. And that liquidity is the oil in the economic engine. So when you lower interest rates, you're trying to get growth going. Let's move on to segment 2.
We have to talk about the politicized pivot. Jerome Powell's term ends May 15th, but he feels compelled to stay on as a governor, the first chair to do so since 1948, saying he won't leave until the legal attacks on the Fed are well and truly over. We are entering a two-pope scenario. Powell remains as an institutional stabilizer against political pressure, while Kevin Warsh prepares for a regime change. Warsh is signaling a pivot toward truth-seeking over communication fluff, aiming to kill the dot plot and shrink the Fed's $6.7 trillion balance sheet.
Mike, how does uncertainty at the Fed level trickle down into real decisions? Where do you see risk and opportunity?
I think I see Santa. Look, the Fed has one job: to make the Treasury look solvent. That's it. And never, ever, ever watch what they say. Only watch what they do. I frequently will simply mute what they're saying, and I look at what they're doing. I look at the body language too, because that usually says it all, but I don't want to hear what they say. I don't care what they say. I care what they look like, and then what they're actually doing. And that has actually afforded me tremendous returns over the past 20 years. We're in an absolutely remarkable situation here. I think that a revamp of how inflation is counted is going to be extremely valuable. And I do believe he's a bit true blue in that regard. Warsh is. And even more importantly, in my view, this White House is. When I say White House, I mean Scott Dissent. Scott is probably the smartest treasurer we've ever had in the White House. And I'm biased because I know him personally. But he is really smart, and he sat on our side critiquing what's going on. And look, as soon as he got into this White House, he just started lying because he had to lie. And I mean lying as in, we need to get inflation down, and we're going to do that by having higher wage growth. And he literally would say that in the same sentence. and that he literally, as soon as he came to he said that, I was like, oh my God, he has to start lying 3 weeks in. But he's saying things that don't make any sense. And there's a reason for it. The reason is that he needs to get buyers of the Treasury. And so he truly understands his job, and that there's twofold. Like fella Jürgen said in Europe on the Greek crisis, he said, well, when it's really serious, you have to lie. And that's kind of, that's Juncker. Juncker said that. That's who said that in the Greece crisis. So they're lying all the time. But I do think that Warsh with Scott is going to put together a different inflation measurement matrix that's going to be a bit more accountable and real time. And it's going to help us a lot. Look, they wanted these mystery mechanisms in order to fudge the numbers, BLS and all this other stuff. They wanted this cloak of nonsense so that they could better manufacture the numbers and smooth it out and lie to us and mislead us. That's why we've always had these busted, ridiculous systems to measure the beans out there as to what's going on, and do this senseless surveys that they would do. And it doesn't make any sense, and it's lagging. And what is the actual, fail rate, meaning there's a bias in who responds and who doesn't. And then they're trying, they got 1,000 PhDs to figure out what that bias is. What are these people doing? They have 25,000 people there. Are you kidding me? All these things have the great potential to change. At minimum, we have the potential to change. And I think it will be for the better, and we'll have a more accurate and responsible Fed. And that responsibility is going to force fiscal and accounting responsibility too. And those things are good. And it might be painful, but just remember the most important thing when push comes to shove and the rubber hits the road, the Fed's job is to make that Treasury solvent, and they will do what it takes to do so.
Kruti, from a data standpoint, does less forward guidance actually help clarity? What are your thoughts?
Oh, he'll love that. No, less forward guidance will be the best thing ever. Because hedge funds are back, baby. We get to bet on crap. So I'm looking forward to it. This is exciting.
Kruti, what are your thoughts?
I agree with what Michael said. I think that forward guidance and trying to interfere with what people's expectations should be. I just wanted to add to a point to what Michael said earlier. One of the reasons why we see more and more lies than we have ever before is because these people have become like celebrities. In the past, before Twitter and before, news cycles going on 24/7, they got that one chance, one meeting, one announcement, and that was done. Now they are constantly in the news. And I hate to say it, but I think that's the reason why Powell doesn't want to quit, because he's a nobody the minute he goes out of the board of governors. This way he stays, he gets the drama, he gets exactly what he's been trying to do for the last so many years, like the attention and the power to say, this is what people should do. And this is what people should do. And it's like, you do your job, we can do ours. But that's hard to get. So maybe I'll meet Santa today. I don't know.
Yeah, did that start with the Greenspan briefcase?
What?
Did that start with the Alan Greenspan briefcase?
Well, kind of, yeah. But Greenspan was not as bad as what I've seen in the last few years with all these people wanting to get a piece of the action and public figure presence. It's gotten really bad in the last 12 to 14 years, I want to say. And that's when, around the time when they changed the current way that they were measuring the inflation and the data that was collected. All of that changed around 2012. So it fits right in with what Michael was saying about there's a narrative going on rather than the truth.
Gary, what do you think? Can the Fed shift how it measures inflation?
So I think they have been shifting. That's been an ongoing thing for decades. I mean, the most significant one was changing the calculation of housing from actual housing costs, like Case Shiller, to OER, owner's equivalent rent, right? Which hugely understates the largest part of the index. So this idea that all of a sudden, oh no, they're making a change. They've been making changes for decades and they all understate inflation. And if you don't mind, I also want to address some of the things that Kruti and Mike were saying. First of all, I'm completely with Kruti. This is the chattiest group of Fed governors we've ever had. I've been saying for years that I could just stick a random microphone at the end of my driveway, and by the end of the day, there would be 3 Fed governors there giving a press conference. These guys should all talk less. You know, Mike was saying they got 25,000 people there. They're all Keynesians. They're 25,000 people with one brain, one set of training. They're all. Why do they need more than 2? I don't get that. Beyond that, he's saying they've got one job. This is true. And we've done the analysis at Deep Knowledge Investing. And by we, I mean one of the interns here. The Fed's dot plot is completely pointless. These guys are completely incapable of forecasting at the beginning of the year where the Fed funds rate is going to be at the end of the year. And that's the one thing they actually control. Mm-hmm. Separately from all of that, there's all of this rending of garments in the past year about, you know, attacks on the Fed and, you know, the Fed is losing its independence. It's being politicized. Yeah, except the idea that the Fed has ever been independent is itself a fiction. If you go back, FDR picked his own Treasury secretary as the Fed chair and insisted that was the case. Lyndon Johnson literally picked up Arthur Burns, his Fed chair, slammed him into a wall until Burns agreed to lower rates, which led to more inflation. Nixon applied private pressure for lower rates as well. The only difference between what happened before and what we have now is that President Trump does this in public. Right? It's the exact same show, the exact same influence, the exact same outcome. We're just getting to see it in real time. And people are saying, oh my God, we've never seen this before. But, you know, if you know the history of these things, this has been going on just in private since the beginning of the Federal Reserve.
Mike, if there are a lot of lies being made, how do you filter out to figure out the real information?
We have to review what is important. All right. What is happening? What has changed that is dramatic, formative, and will have duration? And one thing that has changed that is absolutely dramatic, and I'll go back to Scott and Marco Rubio. Scott believed before he got in here that Xi and China is the most dangerous man in the world. And we have to basically hinder China to the nth degree. And in the past year, we have dismantled the Belt and Road Initiative. That's $1.7 trillion. He's never getting back, ever. And the influence is vanishing. China has infiltrated the United States with money so deeply into every university, into most electoral jurisdictions, certainly into the political parties, very deep and very hard. And what we do is we've cut them off at the knees economically. Panama, both ends, gone. You no longer control that. Venezuela, gone. Argentina, gone. Brazil, next. Colombia, next. Mexico, next. Cuba, next. That's just this part of the world. Canada completely infiltrated Chinese. That's on the, and you see it in our trade policy. We are basically kneecapping them. And then we'll go on over to what's going on with their energy. Iran was their sponsored evildoer, and that is now gone. Many layers of Iranian management has been shut down. Their cheap oil at $40 a barrel that went into China from Iran is 20% approximately of their oil supply, gone forever. Now they have to pay a real wage on that energy. It's going to be terribly disruptive. China is in unbelievable economic dire straits, kneecapped to oblivion. These are really big things that have happened, and those in the media have not pieced it together with a gigantic expose as to what's actually happening. And it is right in front of your face. And what it is going to do is going to put the United States back on center stage in a very, very long-lasting, hopefully big way, undoing what was done between Obama and Biden. And what that really was a welcome mat for Chinese money and influence, whether it's being laundered money through US aid, going into the NGOs and finding its way back into Act Blue and all these other elections throughout the US, or the DEI initiatives that were mandated into all the universities, which completely wrecked our education system with a ulterior, horrible, miserable, evil influence through all of our education for our kids. All of it gone in sub 2 years. Unbelievable. And now we're going to see that. I never thought that Trump will get into the White House alive. And I'm friends with a lot of these people, one of them being Vivek. And I told him, once it was pretty clear Trump was going to win in the summer, I said, that's it. They're out of options. They're going to reduce the Secret Service security and get people to take shots at him. And that's what's happening and happened, because once Trump got into that White House, he'd find the paper trail. He'd find the paper trail for what happened at the CIA, FBI, US aid, and on and on and on and on. And now he has it all. And we're going to see the court cases now come out, and it is going to be incredible drama. So what I think about is the next news cycle, and that's going to be the trade. And Iran goes away because the news cycle is going to get old. And the next thing is going to be Obama having to testify where he will take the fifth or not show up. It's going to be a very hot, wet American summer.
This is a real life game of Stratego. Let's go to segment 3.
The viability of the entire economic narrative hinges on one number, 124,000. That is our make or break threshold for non-farm payrolls, the break-even point necessary to keep pace with population growth. We've seen the healthcare sector masking a stagnant private sector, where the federal government and financial activities are already shedding workers. When a 21.2% gas spike acts as a tax on disposable income, the 124,000 line isn't just a statistic. It's the definitive signal that the essential consumer buffer has finally cracked.
Kruti, help ground this. Why is that 124,000 number important?
Okay, so it's going to sound crazy, but 124,000 is the closest we can get to getting a per capita GDP. And that is what a lot of people confuse with the median household income. Per capita GDP is supposed to be around, for adults, if you consider only per capita GDP for adults, it's about 120K in the US. But the median household income is about 60K. So there is a huge disparity, and it kind of goes back to what Gary was saying earlier about that shrinking middle class. And this is the reason why a lot of our population-related policies, a lot of household choices, a lot of domestic spending, all of that is being affected by this. And in the meantime, we are substituting local production with cheaper imports. So that $124,000 number is, it's like me randomly saying, like, 50,000 sounds like a good number. Like, let's just go with that, because it depends on what the GDP is measured as. But the GDP, I don't know if any of you have heard of it, and I'm sure given the Keynesian references and the other references I've heard, it's a guns versus butter debate. What is that GDP made up of? Is it things that people use, or is it things that are being produced? Or because you could create a lot of guns and make it seem like we have a lot of very high GDP, but people may not have butter to eat with their bread. So,
Gary, what are your thoughts? What if the consumer buffer starts to crack?
So I think it's really interesting, Andy, that people talk about us having a consumer-led economy. Let's just stop and think about that for a minute. Real GDP. I don't mean the government fiction. I mean, real GDP has to do with production. And yet we talk about consumption. Yeah, I listen, I get that one person's consumption is another person's profit. And that's great. I understand that. But we talk about consumption as if that's the thing that makes our economy work. It's not, it's production. And so even the way we talk and think about these things is just wrong. Regarding that 124,000 number, I think it's really hard to tell with the employment numbers. First, they're regularly off by enormous amounts, sometimes an order of magnitude. The revisions are enormous. They're working on that now. Hopefully they get that fixed. But also, people have been saying the economy is bad because the jobs numbers have been weak. I would argue that a lot of that is reduced waste from lower government employment. So yeah, that lowers GDP, that lowers the number of people working, but are we really missing something here? I think it's a good thing for the country to have fewer people wasting money, our money, right? And we're paying for that. We're paying for it through inflation. It's this hidden tax that people don't understand where their money is being stolen from. I don't know if any of you guys have seen the posts by government employees who can't find jobs making what they were before in the government. That's a giant violation of the social contract. It used to be that you'd go to the private sector to make a lot of money, but you took risk. And if you wanted to be secure, you worked for the government, but you made less. And that's why they could talk about government service. Now you've got people in the government making enormous fortunes, not working particularly hard, not responsible for anything, right? They thought they had lifetime employment. I talked to my friends in DC. They're telling me it's like the last days of Caligula there. And the final thing that I would add is that while the number of available jobs has fallen, repatriations have shrunk the labor pool. And so, if the jobs number comes in, first of all, on that, that's why the unemployment rate hasn't changed that much. We've had a reduction in the number of jobs available, but we've also had a reduction in the number of people seeking jobs. This is not a bad thing. The way it's being reported, I think, misleads people. And the final thing I would add is that if the jobs number comes in 10,000 or 20,000 or 25,000 above or below this make or break line, I wouldn't change my portfolio, right? It doesn't change the way I'm going to invest based on that.
Mike, what's your view on AI's impact on jobs today and going into 2027?
So for those of you that don't know, I also am involved with several private businesses, and we are early adopters, if you will, on AI, and it is the effect is profound. The productivity for certain spaces, and this is essentially white collar button pushers, endangered species will be the word, endangered species. I think we are going to see wage growth among white collar stop, just halt. And all of these people are going to have, we already see it. I already see it in the real world. And we're going to see it in the data very, very soon. I think we're going to go from a K-shaped economy to an E-shaped economy, capital E, where guys that can hold a hammer on the bottom are going to do well because you can do something that others can't, which is hammer. And then the top end is going to do well because they own the assets and actually have control. But all the white collar in the middle is going to shrink in wages. And I see it now. I'm very, very worried about it. And it's why I believe that 2027 is going to be the beginning of, and maybe we'll get some disagreement on this group, negative pricing power and disinflation. I believe that is what we're going to see, is prices going down. But that's not only after we see several quarters of margins exploding at companies. Every single company that I know can do more with less, and they are firing people right now to do so. And so margins are going to explode, and it's going in the back half of this year, and it's going to look like a panacea, offset by a bit of inflation on input costs. But that is all going to comp next year. And we're looking at major easy inflation comps next year. And I think we're going to go negative because margins are going to be so good at companies. We're going to find the lever to get share is going to be cutting price. That's what I believe is going to happen next year. And so we're going to have a problem with wages, a problem with the growth in savings as a cause of that. And what we're going to see is negative pricing for 27. So I'm extremely bearish on 27 for these reasons, and for like one of the few times in my life, gold is going to be a big winner.
Interesting. So cautionary words there, something to be watching for as we go into the later part of this year and into 2027. If you've just joined us, welcome to Inspired Money. I'm advisor Andy. We start with inflation data that just came in hotter than expected, not marginally higher, but persistently higher. And at the same time, growth is slowing at the edges, especially in areas tied to consumer pressure. So instead of a clean story, we now have a split screen economy. One part that's still running hot, another part that's under strain. And then comes the deeper question. What if the entire idea of a neutral interest rate no longer means what it used to? Because when debt, financing costs, and structural deficits move this far, the baseline can shift. And when that happens, policy stops being about fine-tuning the economy, and it becomes more about managing contradictions that don't resolve cleanly anymore. So let's move on to the next segment. We're going to break down the data and the stories, whether policymakers are ready for them or not. Let's go to segment 1.
Yesterday's March PCE release served as the ultimate truth serum for the Fed's rhetoric. Headline PCE came in at 3.5%, its highest in nearly 3 years, while core hit 3.2%, driven by an 11.6% surge in energy. Meanwhile, Q1 GDP disappointed at just 2%. It's a split-screen economy. AI is on fire, but middle-income households are struggling with $4 gas. With numbers like these, the Fed is paralyzed. They cannot pivot to cuts without risking a 1970s-style second wave of inflation.
Kruti, when you saw that PCE print come in, what was your reaction? Confirmation or surprise?
Would you believe it if I said that I don't believe it? Like, okay, so they just made another number up. I kind of want to go back to what we were saying earlier, that when we hear these numbers and we are faced with the media repeating these numbers to us, it's easy to feel like we are immediately affected or we have been recently affected, and we have. But at the same time, we need to keep in mind that this is a trend to consider. There's ups and downs, and that's part of our day-to-day. It's like you could be a happy person in general, but there's no way you're going to be a happy person all 24 hours of the day. You're going to have ups and downs. And that's actually how the economy would work as well, except there's that constant external pressure which amplifies on both sides, the negative and the positive. And that kind of creates a swing effect for most of us decision makers, whether for our businesses or for our personal lives. And that is what, so it came in exactly where I thought it would, but they have been talking about it for months. Like it's always been, ever since the conflict started, like, oh my God, we're not going to be able to afford anything. It kind of goes back to what Gary was saying. It's always something. It's always something that we are scaring people with. Because when people make decisions out of fear, it makes it easier to manipulate them. I hate to say that, but that is the truth. And we are teaching them to lead with fear instead of leading with confidence. And it really worries me for the next generation who hasn't seen a time when media was not the ruler. So that I don't know if that helps, but that's what I keep thinking about. It's like, oh wow, we have another fear mongering technique going on. 3%, 3.2% sounds really big, except when you look at the actual numbers, they're not that big. Yes, the gas went up, but it's not everything that immediately got affected. People who had hedged against it are fine. If you decided to buy the biggest, most gas burning car and you have to pay more, I don't really care because you're not the average guy, So I don't know if that helps, but that's my take on it.
Mike T, are we closer to disinflation or stagflation?
Sorry. Oh boy, that's a really good question. Look, this inflation that we're going to have is going to compound this year. So and that'll be it. And the comps I have going forward is just flat out negative, large, big. So that's kind of my take on it. And I don't know how we have otherwise. So far as stagflation, that's a word that they say on TV. I don't really know what it means.
So you're not worried about that?
It's just a word, just like recession. It's a word that they say to define a feeling. So I'm just trying to, call it as I see it, and what's going to happen with stocks, and the labels I'll just leave for other people.
If there's disinflation, how does that influence your book?
Oh, healthcare is going to kill it. Pink. I guess I'm not. Well, I guess I can pitch my fund. I'm not allowed to talk about the performance, but I encourage you to look. But I think next year is going to be gold, healthcare, a couple other things, and then the real hinge is going to be, the big issue is that it's virtually impossible to spend more on AI for 28, and so they will view 27 as the top, and what they do with these stocks. So we may have one hell of a doozy for 27.
Something else to watch for. Yeah. Gary, if inflation stays sticky here, do you think the Fed is stuck? Will they be able to cut rates if growth slows?
I think the Fed is stuck no matter what. There's nothing they can do, right? As long as Congress is going to overspend, then the only thing the Fed can do, and Mike talked about this before, is finance it, right? They enable it, but they're not the ones doing it. I also like, Mike and Kruti are both sort of channeling Drew Carey from Whose Line Is It Anyway, right? That government statistics where the scores are all made up and don't mean anything. But at this point, the Fed is irrelevant, right? Like we all watch, everybody tweets or posts, whenever we have a Fed meeting, happy Fed Day for those of you who celebrate, right? I mean, it's just become a running joke. They're irrelevant because there's nothing that they can do to stop inflation. The government's going to keep printing, and the Fed is going to keep enabling it. As Lynn Alden says, nothing stops this train. And we're having a good time here, and we're laughing and joking. But the one thing that is serious is that it's this insane multi-trillion-dollar increase in spending and the resulting inflation combined with 5 decades of offshoring that crushed the middle class. And their spending power and their savings is being stolen and wasted by the government. There's very little they can do to get ahead. And, again, the Fed enabled it, but they didn't cause it. And so, I think Mike is right that he's sort of saying, like, why are we looking at this stuff, right? These things get a ton of attention and entertainment and headlines in the newspaper, but does it really affect the real economy? Do you really think anybody who got in their car and drove to work today, who commuted, was, really worried about whether the Fed raises or cuts by 25 basis points? Right. I just don't think it matters. And I don't think there's anything they can do. And, that's the sad part about it. I guess it was funnier when I was quoting Drew Carey, but, this stuff does matter.
Drew Carey, not expected to have Drew Carey mentioned today. Let's move on to the next segment.
We need to recalculate R star, the neutral rate that neither stimulates nor restricts the economy. What was stimulative in the early 2020s is now restrictive because our national debt, now at $39 trillion, has changed the floor. We are mirroring the post-World War II era of 1947. Just as supply chain normalization defined that period, the current policy lag from energy shocks is dictating the neutral rate. Interest rates on marketable debt have already climbed to 3.4%, signaling a permanently higher floor.
Mike, how do you think about the national debt levels and the investments that you hold?
Look, the U.S. is going to be the least dirty shirt in the hamper because we have the capacity to grow our population, or at least stabilize it through importing people because they want to be here, because we have rule of law and contract law, and We defend IP, which makes us quite novel. And anybody that you don't have to have certain connections politically in order to get a loan to start a business. It's all done on, or mostly done on merit here, unlike in Asia or in the EU. So it really is the land of opportunity. And if we keep it that way, we're going to be okay moving forward on the economics part. But so far as the national debt issue, and I know how Scott thinks, our only out is a productivity renaissance. And there is a strong probability that AI is going to help us do that, with it, where wages are going to halt, if not go down, for the white collar and for a period. But then, because this is very abrupt, what's happening, it's happening very aggressively, and there's going to be, it's too strong of a transition, but it's going to happen no matter what. And we're going to have this rough period for 3 years, in my view, as people get resorted. But you're going to have a lot of bright white collar people getting displaced. And it starts with 3 people in a garage with an idea. And frequently it's done out of necessity. You can't get a job, so you start a business. And this is what's going to happen. This is the reinvention of America. And that is our way out of it, is going to be incredible productivity that boosts GDP growth. And I think there's a decent chance that the yield curve is going to force us to be, let's say, a touch more fiscally responsible. And I don't mean meaningfully so. I just mean that the comps aren't so big. The government will continue to overspend, but year on year, it may be quite flat, which is actually terrible for the stock market. But productivity will push us through over the next 3 years.
Gary, what are your thoughts? Should I be telling my kids to be blue collar workers and not white collar workers?
I don't. I think it depends on your kids' aptitudes. The thing that I do know is that in many cases, being a tradesman, being an electrician, a plumber, somebody with HVAC skills, maybe a better, more lucrative career path than going 6 figures into debt for a variety of college degrees available now. And people say, yeah, but what about the college experience? But, that's a very high price to pay for, a lot of partying, and, it's fun. They have a good time, but I don't know that that's really a career path. So, I think there are some concerns there. Mike also just mentioned the yield curve, and there's something that's really worth exploring here, which is a lot of people think the Federal Reserve controls interest rates. They don't. They control the overnight rate. The bond market controls the rest of the yield curve, everything from 1 week out to 30 years. So, the Fed, there's just a limit to how much control they have. In fact, several years ago, I wrote a short ebook called Counterintuitive Inflation, where I said the Fed is trapped. Lower interest rates reduce interest expense for the government, and higher rates help address inflation, but lead to more money printing, which actually leads to higher inflation. I've been watching Japan for years and have been talking about the reverse carry trade since 2022. And that's the dilemma the Bank of Japan is facing right now. And, the thing that I say every time I talk about it and write about it is, don't get smug, right? Just look at everything that's happening in Japan and the issues the Bank of Japan is dealing with as a preview for what our Federal Reserve is going to have to deal with, right? It's like Mike said, the least dirty shirt in the hamper, right? We're following the same path that they are. It's also worth pointing out that people talk about $39 trillion of debt as if that number is meaningful to the human brain, but that's actually not the right number. That's the on-balance sheet number. But the off-balance sheet liabilities, things like Social Security, Medicare, Medicaid, pensions, these are real liabilities, right? And not counting them is like saying, well, yeah, I was able to pay all my bills this month, but you have a gigantic American Express bill that, or credit card bill that, you don't have to pay the full amount. I'm saying, oh, well, I'm fine. I haven't gone bankrupt yet. But those liabilities still have to be paid. And what a lot of people don't know is that those off-balance sheet liabilities are probably worth about $200 trillion. And so to do the math for everyone here, that means the total liabilities of the U.S. government are in the neighborhood of $250 billion, $250 trillion. that can't be paid. So I laugh whenever I see people saying, "Oh, we need to tax billionaires." Great. Where are you going to get $250 billion? That's not the issue. And so, I've agreed with just about everything Mike and Kruti have said, but the one place where I might disagree with Mike, where he was talking about deflation, and granted, he was talking about the short and medium term, and I'm thinking more long term, is the US government is going to need inflation because there's no way they're going to be able to get their hands on $250 billion. So the dollar is going to be debased into oblivion. And again, going to his least dirty shirt in the hamper metaphor, which I agree with, all fiat goes to zero. That's been the case throughout history. Every government's currency is just being debased into oblivion, and that's been the case for thousands of years. But that's the direction this has to go. And if we do have deflation, and I'm going to rephrase deflation as your dollar has more purchasing power, what that means is that $250 billion becomes worth more. And our government is not going to stomach that. We can't stomach it. And the only way out of this is a stealth default, which is just a fancy way of saying more debasement, more inflation.
Kruti, what's your reaction?
I agree with a lot of what Michael and Gary said, but I do want to add the caveat that and this might be our out, is that our production possibilities curve, how much we can produce as a country with the resources we have and the new technology that we are trying to embrace anyway, could shift. So if you think about the way the curves work, the aggregate supply, if we shift it out, we could have a situation where we have lower price levels, which in the short run would be higher price levels, but in the long run could be deflationary. But inflation and deflation both are short-term over a period of time measurements. What needs to be done is to look at the real price levels, and that only gets changed when you have real outputs that are being used for measurement. So that's where that whole, it depends on how you define it, kind of a situation comes up. What is efficient productivity, for instance? What is your productivity is defined by how you define efficiency, which might not be the way another country defines efficiency. So we have to go in that. It's a circular issue because our money decides what it's worth, but what it's worth is deciding what our money is. So it's like playing Monopoly. It's like, oh yeah, well, I have more money than you and I just passed go, so I got another 200, but did you really? So
we're going to bring it home and go to the last segment.
The unholy trinity of oil shocks, job losses, and sticky inflation is the defining macro analysis of this quarter. With the U.S. debt hitting $39 trillion, we have entered a state of fiscal dominance. Interest costs now consume a growing share of federal receipts, creating a feedback loop where high rates actually inject more liquidity into the system. This is the stagflation remix. The Fed is stuck between protecting the dollar and preventing a total collapse of a labor market that was already revised downward by nearly 1 million jobs last year.
Gary, what's your outlook? Do we get out of this without inflation? Is there disinflation? What do you see ahead?
So, Andy, I want to address this in the right way, because usually when people ask me that question, they're thinking about the very short term, right? What are we going to see next month, or later this year? And the truth is, I don't know. The numbers are, they're faked. The inflation numbers, there are so many adjustments. And if any of you think they're making adjustments to make inflation look higher than it is, I would disagree with that. I think, anytime the government is making these adjustments, they always adjust in such a way that we understate inflation. So, we definitely have inflation. Our government has an incentive to keep creating it. One of the things I think where we all saw behind the curtain is when, DOGE started to uncover just epic levels of waste and fraud and abuse. I think people were shocked to realize Oh my God. I knew that every government has corruption, and I know there's always a certain amount of waste, but I think now it's very clear that some huge percentage, maybe, the majority of government spending is fraud and waste. And, what we saw was people saying, hey, wait a minute, this is terrible. We should put a stop to this. This money is being stolen from all of us. It's leading to inflation. Our purchasing power is being stolen. It makes it very difficult for people to get ahead, to save in dollars. You can't save in dollars. And you just have this situation where once that happened, people were saying this is terrible. And then half the country said, oh no, you can't look at this. It's wrong. It's bad for you. You're cutting valuable programs. And they would list the name of the program. And they would talk about, healthcare and helping people. And yeah, that's the title. That's the name of the department. That's the name of the program. But that's not where the money is going. That money is not actually going to helping people. It's not going to production. And you just saw these people circling the wagons and saying, you're a bad person for identifying our fraud and waste and abuse. And, Congress could have voted to say, hey, we're going to adopt Doge's suggestions, but they never held that vote. They just correctly said President Trump doesn't have the authority to cut that spending. Okay, they're right about that, but the fact that Congress didn't do anything, the fact that Doge had to shut down, the fact that Congress got angry and said, how dare you identify our fraud and waste? I think that was the tell. I think we all saw behind the curtain. And so, again, this is terrible, but it's not going to stop. And so, we can be angry, we can be upset. You can wake up and have a bad day. The thing that I do is I just prepare my portfolio to benefit from more inflation. And, it doesn't make me happy, but losing money makes me really unhappy. So, that's the appropriate response. We can't stop it. It's not going to stop. Nobody in DC is going to stop it. Nobody in the White House has the authority to stop it. So, buy the things in your portfolio that will benefit from continued long-term inflation. Andy, to answer your question, I don't know where the next inflation print is, but I know what it's going to look like over the next 5 to 10 years.
Mike, there was a message from James who says that he's also he's a large pink investor. And his question is, thoughts on Bitcoin?
Oh my God, stop. Look, the Genius Act, as it gets implemented next year, is going to make it extremely obvious that there is no place in this world for Bitcoin to actually be a true matter of commerce. And that's why I think Bitcoin is the biggest tulip craze of all time. And it's really ridden a liquidity wagon of incredible M2 growth, where so many more dollars chasing scarce assets, and many of which are very thin, like Bitcoin, can be manipulated and make absolutely no sense in my humble view. So I would much rather be long a gold and a pink than I would a Bitcoin.
Mike, you mentioned that that healthcare is a good sector when there's high levels of debt. I mean, you're confident no matter what's happening in the stock market, you can go long and short. You're going to figure out a way to trade and make money. What matters to you right now when you look at oil shocks, job loss, inflation? What do you think matters?
Well, there's two ways. You got to look at two things. What is the world going to look like 1 year from now? And always have your eye on that. And then the other one is, what is the world going to look 2 weeks from now? And that's it. And anything kind of like, what is it going to look at 3 months from now? I don't know. So I really try to focus on kind of 2 weeks and 1 month ahead, and then 1 year ahead. But the road that we get there is going to be so bumpy. That's where all the trades are made, is along the bumps. And this is not what I want to do. This is what I have to do. And this is, many of our panelists here would probably agree. The world is not how we want it. It is how it is. And our job is to make money. Being right is for people who write books. making money is for us. And so being right is irrelevant. I simply have to put up the numbers every month, and knock on wood, 25 years have been successful at doing that. But every minute of every day, I always think this month is that last month. This year is that last year. This will be the year that I'm down for the year. And as long as I'm thinking like that, and I never look at what I did, I always look at what I'm going to do, and keep that system in check, it tends to work out well. It's just a perpetual insecurity. And I'm good at that.
I like the make money mindset. It's a good way to reframe how to think about what's happening in the world and how that can translate into the stocks or the bonds or whatever we own in our portfolios. Kruti, do traditional economic models still work in this kind of environment, or are we in new territory?
Well, I'm going to say that when we go back to, when we call it traditional economics models, which ones are we referring to? Because kind of going back to what Gary was saying earlier, majority of the economists that I deal with right now are so heavily Keynesian biased and so heavily into government needs to take care of everybody that they're not traditional economics models. They're philosophical models. The actual traditional economics models go back to having rationality as the decision-making mechanism for any individual, whether it's a firm, whether it's a person, whether it's a business. Goes back to what Michael just said. You know, I may not like doing what I have to do, but this is what I need to do to make money, then I'm going to do it because that's my goal, is to make the money. And when we go back to the core classical economics models, going back to Ricardian models, Adam Smith's models, we find that keep the government out of it. Let people make the decisions based on what is actually in demand, what is actually being supplied. Let them have the freedom to build what needs to be built, because that's the only way the economy grows. Anything else, any other interventions is going to destroy the ability of people to buy what they need or to sell what they can make. And so when you say that, is the traditional economics models collapsing? No, the real traditional models are not. Are we in a completely new, different world? Yes, because Keynesian models were based on completely ignoring rationality to begin with. So yes, those might need to be revisited big time. But will it happen? Well, is there a Santa?
I think we're going to leave it there. We've been chasing Santa for the last hour or so, and I don't have a conclusion of whether or not we're going to find Santa this year. I want to thank our incredible guest panelists, Mike Taylor, lead portfolio manager of Pink Simplify Healthcare ETF, where I think 100% of profits go to the Susan B. Komen Foundation. So doing great work
my
there.
Compensation too.
What's that?
Including your compensation. 10%.
So learn more about Mike and Simplify at simplify.us. Gary Brode is managing partner at Deep Knowledge Investing. You can find more about him at deepknowledgeinvesting.com. And Dr. Kruti Lehenbauer, founder of Analytics TX. You can find her at analyticstx.com. And if you want to keep up with their latest thinking, because the ideas don't stop here. Mike and Gary are both very active on Twitter, so go follow them. Kruti and I are active on LinkedIn, so we hope to connect there. I'm going to bid our guest panelists farewell for now. And we spent the first part of this episode unpacking inflation, the Fed, the broader economy. Let's transition to how you actually navigate all of this in your own life and career. What if the biggest career advantage isn't your resume or your skills or even your experience, but your network? And more importantly, what if you've been building it the wrong way? This is Inspired Money. I'm your host, Andy Wong. We've been spending this episode breaking down inflation, the Fed, the economy, and we're going to shift from macro forces to personal leverage, because no matter what the economy does next, your ability to navigate it comes down to one thing: who you're connected to and how you show up in those relationships. Most people think networking is about collecting contacts, but what if it's actually about access, resilience, and opportunity flow? What is the right connection at the right time? And what if it can change everything? So for the next 30 minutes, we're going to be joined by a friend of the podcast, J. Kelly Hoey. She's a networking expert, investor, and author of the new book, The Social Billionaire, a practical roadmap for building the kind of relationships that create real opportunity. She's widely recognized for her work on the power of social capital. She's been featured in major media outlets and helps professionals rethink how they connect, collaborate, and grow in a rapidly changing world. Kelly, great to have you back on Inspired Money.
It's a joy to be here always, Andy. Thank you.
And thank you for your patience, since we got started a little bit late and you've been generously just hiding behind the scenes in the green room.
Hey, listen, hanging out in this green room was fantastic. That was an amazing conversation. And if people are just tuning in now, I encourage you to go back to the beginning and listen to the whole thing. It was fascinating. Absolutely fascinating.
Thank you for that. I look forward to chatting with you for the next 30 minutes. I think we're going to break things down, like how to audit your network and separate real support from surface level connections, why high performance or why high performers need a powerhouse inner circle, not just a broad network. And we're going to talk about your 5, 4, 3, 2, 1 framework that people can use every week to create momentum in new opportunities. The world is changing fast, industries shift quickly, roles change quickly, and nothing feels fully stable. If that's the case, your network isn't just helpful, it can be your safety net and your growth engine. So let's get into it. Let's go straight to segment 1.
Kelly Hoey argues that expertise and a goal are just your starting point, but gaining access changes your outcome. We're diving into the network audit, a reality check for your career trajectory that asks, who actually revolves around your ambitions? When you face an accidental pause, a sudden disruption or sector contraction, you have to retrace your steps to identify which connections fueled your stamina and which were merely transactional noise. Use the why filter to ensure every networking choice adds genuine value and aligns with your long-term goals.
Kelly, you say that expertise and goals are just a starting point. Why does access ultimately determine outcomes?
It's I'm going to say it's such an important question, and I think it's becoming more and more important. I had a conversation earlier this week, Andy, and it was all around AI. And one of the things that AI has done, to use this as an example, is it has kind of flattened out the social signaling of someone's interest in a job, because now you can get a really good cover letter written by AI. Whereas those who used to invest in a solid cover letter for an employer, you could say, okay, we got 2 equal resumes, but this kid put a lot of work into this cover letter. And so now you're like, okay, well, what distinguishes my resume from everybody else? What distinguishes my business pitch from anyone else's, right? And it comes down to recommendations, like a real human who can vouch and verify, your skills. This is the workaround. So this is where you've got to say, all right, how am I engaging with other people that they're going to put their social capital, their reputation on the line for me?
Let's make this practical. If someone listening wants to do a network audit this week, what's the first question they should ask themselves?
I think the first thing is, when you said, if have someone do it this week, all of us should do this all the time. I mean, you review your portfolio, right? How often do you check the stock market? Or, some people might be doing that way too frequently, but how often do we check our portfolio? How often do we sit down with a financial advisor, right? And sort of say, do I have the right mix of assets, for what it is that I want to accomplish, what my short-term, medium-term, long-term goals are. And I think we need to think about our relationships that way, because we need to think about, all right, am I making the right deposits? Am I spending the right amount of energy? Do I have the right mix in here that shows, right, like where I can do and what I can do, where I can go. So many people, when they think about networking, Andy, they think about having to meet new people. I think I run off and I got to talk to someone new. I got to meet new people, rather than sitting and saying, where have I already invested time and energy? Where are people who can make better and stronger recommendations on where I should be spending my networking time? So for anyone, I was like, it's just, to me, it's just a smart, sensible starting point before you exert a whole lot of time and energy that may just be wasted time and energy, running around networking, thinking you're going to do, find the right people or do the right thing. So know what you're starting from, as well as doing that audit. The other reason to do it is you really need to look in the mirror. What have you done? How have your behaviors and your choices created, the shape that your network is in right now?
Kelly, do you have tools that you use to manage your network?
I'm one of those awful. Listen, I'm like, I wish I did. Like, I wish I could say to me, hey, here it is. You can go and buy it online. Go buy it online for this. Listen, all of us. This is the frustrating part with networking, productivity, all sorts of, I would say, personalities. We all have different ways that we like to slice, dice, and sort things out. Yeah, think about your last four panelists, and as you said at the end, the last three panelists in your last panel, when you said, if you want to keep in touch, two of you were on LinkedIn and the other two were, somewhere else. It's like, we all have communication preferences. We all have preferences on, do we like to receive an email or a text? Are we on WhatsApp? Or are we on Signal? What you need to do is understand your own preferences, your own thinking about the way that you organize things, and then you have to imagine that someone else may actually approach this differently. But as for me, Andy, like right now, in terms of organizing contacts, recognizing that people in all sorts of different places, when I'm thinking about finding people, I am going online, I am going into email, I am going into contacts, I'm looking at a paper calendar, I'm looking at a whole bunch of sources, because people can kind of sprinkle their attention around and their information around in a bunch of different places.
How do you help people to distinguish between relationships that are truly supportive versus ones that feel active, but they're not actually moving forward right now? Because that's kind of dynamic. It's ever changing, right? So you're like trying to manage this moving target.
Well, this is why you need to do a network audit. Because one thing I always say to people is you need to give the right network the right job to do. And the relationships that you're hoping are going to move your business, your career, your venture forward, well, you might be relying on the wrong one, like putting all your energy in the kind of the wrong relationships, wrong for that job, not wrong relationship. So, are you relying on your social, sort of emotional relationships? Friends and family that are well-meaning, but don't have any connection to what it is that you are doing in your career or your business, right? Maybe it's people who are really invested in what you're doing right now and want you to stay in that, and they can't imagine that you would want to do something else. They're terrific, well-meaning people, but they're not the right ones for you to be talking to, the right ones for you to be saying, right? So let me give you an example in that regard is woman by the name of Verily, who I interviewed for both of my books. And when she was making a major career change, she realized she needed to tap in and discover a new network. And she needed to find equally kind of bold, ambitious professionals who stepped out of corporate America to do something entrepreneurial. Because the people she had immediately around her were very invested in the identity she had at that moment, which was someone climbing the corporate ladder on their way to grabbing, the illustrious brass ring, right? And they were invested in their egos and were invested in her status of doing that. And she looked and said, you know what? I got to find a different network because I am feeling this overwhelming urge to try something entrepreneurial. So all of us kind of need to think like this is where this audit and understanding the foundation of where you're starting from. Like you may have all the right elements. You just need to reconfigure, right? Maybe over-indexing too much on asking, mom and dad or your siblings for advice versus asking your, college roommates or asking that colleague from 2 jobs ago. Like, you got to look and see what you're doing and who and what you're going to. As I said, I'll go back to it because I say it all the time. Give the right network the right job to do.
And that goal can change rather quickly, because you talk about accidental pauses. Someone can get an email saying, you've been laid off. Suddenly, you're thinking very differently about your network tomorrow than you did yesterday. If you realize that your network isn't quite aligned with your goal, where you're trying to go, what's a small step that can be taken immediately to start shifting your network?
Well, I mean, this is where, the idea of continuously networking, in the sense of continuously being open to building relationships, in terms of auditing your network so you understand where things are, like where you have relationships, what industries and sectors they're in. This is also where, those tiny steps you can do in terms of keeping in touch with people, like passing on information. If this, I'll just use an example. Today's conversation was helpful, whether the first part, the second part, the third part of today's conversation, pass it on, the information on to somebody who needs it. Those are like little ways, right? If you find yourself in that transition point that it's, the shock to the system, that you're like, shit, I gotta network for that new gig, and you're realizing that, I'll take my own life as an example. I wanted to make a career change. I was over-indexed in lawyers and a lot of bankers doing commercial mortgage-backed securities. That's a pretty narrow network, Andy. But what did I have on my side? I had great relationships with these people. I had been a superb colleague at the 3 law firms I had worked at. And in terms of having people who were in other, areas of the law, other people who had done things that I could then go to and ask questions or seek out their advice, find someone who had worked before, that I worked before with, who had transitioned out of the law. But I'll be honest with you, once I'd identified, that next career, that was a very meticulous, focused, and intentional networking over a period of about 18 months to land the next gig. So what's the thing you can do on a practical basis? Make sure you've got a diverse network. And by diverse, I mean in the fullest sense of the word. Sectors, industries, interests, hobbies, okay? Find ways to, stay in touch. That might be commenting on someone's Facebook post or reposting someone's post on LinkedIn. It could be remembering a birthday. Or, you know what? You think of them and you think of some moment you had together, just send them a note, right? Those little things can, reconnect people. And do an audit of your network. And if you're realizing, there is a big gap here. I am over-indexed in a, certain segment of my professional sphere, go and find something, like challenge yourself to go and do something different. Go and network with different people. Do it around a hobby. Do it around a social interest. Do it around the community.
Diversification. I like it. Great advice. Let's move on to segment 2.
We are moving away from the solo hero's journey toward a networked career architecture. Kelly's research-backed approach differentiates your support systems. You have a social-emotional squad for nourishment, but you need a powerhouse inner circle for strategic, unfiltered wisdom. For high-achieving women, this means prioritizing connections with other gritty women to fuel ambition. Remember, the space between your networks, those disconnected networks, is where your next breakthrough lateral move is hidden.
Kelly, you make a really important distinction between a support system and a powerhouse inner circle. What separates the two?
Well, I think it's part of what we were talking about before. And I really do think, the research in my second book really, it's like 4 years of research on the networks of high achieving and high potential women. And so I got to put that proviso. That's where this research sits. That being said, I think this is an optimal network structure for any of us, and behooves any of us to think about it as we move forward in this very tumultuous, chaotic, job market. So the ideal network structure, as I see it, is you are in the public information flows, the professional information flows of the industry or sector that you want to be in. Or maybe it's geographic, you want a job in New York City or something like that. So where are you getting information? And the old expression, Andy, like, you don't want to be a day late and a dollar short. You want to be knowing what is going on and having like the email lists or the meetups or the professional association, the employee resource groups, whatever it is, that you're getting information on a timely basis. It's coming from a source that you can verify, but it's not necessarily a place where you need to have big in-depth relationships. This powerhouse inner circle, right? When you're looking at having that, your tribe, your personal board of directors, your mentors, whatever you want to call it, okay, is all right. These are people who understand your drive, your ambition, your need to excel and succeed. They are like-minded in that way, as opposed to someone saying, Andy, why are you working so hard? It's Friday afternoon. Why aren't you just watching the market close for the week and going home? Come on, babe. Like, what are you doing? That's right. As opposed to someone else saying, Andy, you're doing inspired money and it's Friday afternoon. You want to have a great conversation? I'm there. What else do you need? How can I amplify it? Maybe a silly example, but hey, it brings it home. So this inner circle is not questioning your drive. What they are questioning might be, I don't know, your presentation. They might be questioning how you're going about it. But there are also people who have social capital who say, hey, Andy, I know you're going for that job. Here's the suit you need to wear. You're looking good right now, but you got to wear a tie because these are tie people. And they always like a cover letter in this font. So don't use anything else, right? And even though it says his name is, like Chip or Biff or something, call him sir, because that's what your inner circle, this tribe does, right? They're either bringing diverse networks, like different networks that can connect you into those. They're also bringing, I want to say, comparable experiences, not identical, comparable, so that they can give you a different perspective. And they are people who are rolling up their sleeves to help you get where you're going. Because the only reason they're going to do that is you're doing it for them as well. So this is not this building of this inner circle. This is not some passive activity of like, hey, it's all about me. Let me bring some people who are going to do things for me. You've got to be doing that for them. Otherwise, good luck with the transaction or the trade of, hey, it's all about me and I'm not going to give anything in return. So whenever I had sort of get pushback on like what should be in this inner circle, I always say to people, what does your ambition need? What does your business need? What does your startup need? What does your career need? Because as soon as you say, oh, well, if it's your soul, if you're tired, if you just need someone to make you a cup of tea and tell you you're swell, then go to that network, go to that social emotional network. But if you want someone to give you the hard truths, if you want a network that's going to tap, their networks, if you want to get into all the secrets of the whisper network, then build that powerful inner circle that way.
I think that you emphasize the importance of surrounding yourself with gritty people. How does someone know that they're actually in the right room or just a comfortable one?
I think you need to look. This is where listening, this is where having those kind of conversations, that's being able to turn to someone saying, here's who I need to be surrounded by. This is where you take an interest. I don't know how many times you've heard this, Andy. I suspect you have. Like, people always wondering what are they going to say in a networking scenario. I always say, how are you going to listen? Because in listening and asking questions, you're going to learn about other people and you're going to be able to understand, are we on the same wavelength? Do we have the same values? Is this person, like they approaching their career, their business, their life in a way that I'm like, yeah, like they've got some, motivation that I can really, get behind. But also too, like I realized from all the research I did for my book, when we say gritty, grit as I define it in the book, is your mindset. And that is something, all of us can work on. You're not born with a gritty mindset or not born with it. It is something that you develop. If you don't have the right gritty mindset for a career or a goal, go back and analyze that. Don't say, oh my God, I don't have the stamina for this. Yeah, maybe it's the goal. Maybe it's the place you're executing the goal. Maybe it's the way you're executing the goal. But go back to that if your mindset around grit seems to be kind of flagging. But grit is, I want to say, it's your mindset, it's your time allocation. If you're not putting the time in for that thing you want to do, well, maybe you got to assess that thing because maybe it isn't what you want to do. Right, gritty, successful, high achieving people, allocate the time towards the stuff they want to get done. And then the third part of it, and this was the most interesting because this sounds like really fluff, self-care. All the people who are high achieving, high potential that I studied for the second book, self-care was critical. We can all laugh at the announcement, you always get on an airplane, put your mask on before you go and help others. But that is a truth.
If someone wants to intentionally build that strong inner circle, listening's important. Is there one conversation that they should start this week?
I think the first conversation, again, back to yourself. What is it that you need? Because then you can initiate a conversation with either with someone or with other people to get the right introduction. So you could say, I've been assessing, okay, I'm going to take me as an example. I'm working on my next book, Andy. Guess what? Venturing out into fiction. Venturing out into fiction in the young adult category. Who knew? Crazy things happen. Anyway, I may say, you know what? I need to have some more contacts who are authors who are writing or venturing into the young adult category. Because you know what? I need to have a little writing group of people who have got that skill set. So that's where I could have a conversation, say, with the editor at Penguin Random House for my first book. And I could say, Stephanie, this is what I'm doing now. I'd really love to talk to authors who have made this switch or who are doing this now, who would want to be part of a writing group. Any recommendations? I know where you sit now at Penguin Random House is next to the children's book editors. Could you lean over across the cubicle and ask one of them? So I think when you're clear, right, on a goal, and you then can look at, and this is going to lead into our 5, 3, 4, 2, 1, Andy, then you can say, what's the action step, right? Here's the big goal. Publishing in the fiction category and likely in young adult. Okay, what can I do to move towards that this week? You know what? I could talk to some other, young adult authors. I could talk to them about either their transition, what they're finding. I could talk to them about, I don't know, networks and communities that they're part of where they're getting useful information on trends in that specific, category of writing. So that's where I'm like, you know what? Every single big goal is always made up by, little action steps. So that's why in terms of identifying, for some people, Andy, they're going to find an inner circle and it's going to ride them through for the next 20 years. And there's an example in my book, The Social Billionaire, and that. Others of us are going to need to see where it is our career, our business, our needs are shifting, and then saying, you know what, I got to make a little adjustment here. Got to tap some different people.
I love how Kelly makes this subject of networking less scary, because for so many of us, if you get into a room, we're going to talk about networking. That's like not inviting to me at all. But
not inviting to me either.
With Kelly's help, things are not that scary. We can go into the room. We can have great conversations. And she set us up perfectly, the 5, 4, 3, 2, 1 framework. Let's go to the last segment.
To flourish in a fragmented era, you need a high-impact action plan. Kelly introduces the 5, 4, 3, 2, 1 framework, a weekly rhythm to organize your ambition, from back-channel inquiries to mentoring others. If you're feeling stuck, try the blank slate reinvention. Imagine waking up with 0 obligations, and decide which ones you would actually add back. Serendipity is a strategic asset. By saying yes to new possibilities and leveraging your social capital, you create an escape hatch from professional stagnation.
Kelly, walk us through the 5-4-3-2-1 framework. What does it look like in practice, and why does it work?
People were really looking for some way to, what can they do on a weekly basis? And so that's why I came up with the 5-4-3-2-1. And also, high five to James Clear, with his atomic habits. So one goal. Okay, what's the one goal you've got going on this week? Like if I, got that meeting or was able to, get a pitch in, or I was, my goal this week is applying for 5 jobs, whatever it may be. Okay. So what is the goal? Okay. What's your top priority? And one of the exercises in the book, the Social Billionaire, I call it the Warren Buffett exercise. Write down everything you got to do, everything you say are your goals, and then circle 3. The rest of them aren't your top priorities, right? So, but I'm saying let's focus on 1. So that's 1 goal. 2 action steps. That we're going to take you momentum towards that goal. Doesn't that sound achievable, Andy? If I said 1 goal and 2 action steps. Okay, I'm going to research companies I want to work for, and I'm going to send out, some cover letters. There we go. That's going to get you towards your goal of getting a job. Okay. Then 3 networking interactions, right? We get where we're going with the help of other people. So what are 3 interactions, right? That could be setting up a meeting. That could be, reaching out to somebody else to, inquire on how they're doing with their new job or what's going on with them. It could be going to an alumni reunion. It could be researching a meetup or, asking somebody about, volunteering. Okay. So 3 networking interactions. This does not mean you have to go for 3. You could go for 3 coffee dates, but that's not what I'm saying. 3 networking interactions could be research, scrolling through someone's LinkedIn and finding a way to comment or send information to them based on what you see their post and interested in. Then number 4, as I like to say, the 4 F's, fine tune. Okay. What's working, what's not working from the week before. Follow up, follow through, right? Those are, if I could correct one networking mistake, Andy, there it is. The number of times people don't follow up or follow through. And that can be really simple. Okay. Follow up, follow through. And the 3rd one is forecast. Okay. You know what? Next week, everyone is off on, spring break, right? I'm going to reach out at this time period to set meetings up, right? Knowing that when everyone comes back from, spring break or the kids being off or, before a long weekend, right? There's your forecasting. Thinking about when would be optimal timing particularly if you're trying to secure a meeting with someone. And some of those things under the 4 F's could be your action steps. I'm just saying. So this is not, not trying to make you do too much work here, people. And then, the 5 is 5 at your side, right? Who are 5 people that you rely on? And are they the right 5 for what it is you're trying to do, right? So that, again, I'm really having people assess that all the time. There it is. There's your 5, 4, 3, 2, 1.
I love it. I love the set 1 goal and set 2 action items. Very attainable.
Right.
And I think the secret is that 5, because the 5 are going to keep you accountable.
Yeah, right. Like if you were, right now, okay, so maybe you're starting a business, right? Who are the 5 you have at your side? Right? And not just people going, yay, go for it, Andy. This is terrific, right? Who can say, okay, what do you need, Andy? Oh, hey, Andy, you were talking about you need some new accounting software. I tried a couple of these and well, this one's more expensive. Here's why it's a better investment in the long run. Or, whatever it may be, right? Like that's thinking about, right, who are those 5? It also could be that, you find that what you need right now is more people who are being a little bolder in how they reach out to help you. Like they're not just like, hey, Andy, just let me know what you need. I'm here for you. You need someone who's like, Andy, here's who you need to talk to. I'm going to get my assistant to make the meeting, schedule the meeting with him because she can get through to anybody faster than you and I. And you and I are going to sit down the day before the meeting, and we're going to go through what you're going to talk about with this guy. And I know you already know him, but we're going to do that. You might be like, you know what? I need that person right now. So that's why, again, you think there's times when we're relying on someone or a portion of our network and we're getting demoralized. We're getting right? You're feeling like frustrated because they're not helping. It's like you might be tapping the wrong people right now, right? Find the people who are going to give you what you need. And again, this is where that audit comes in. You're going to know the assets you have. You're going to know the network and the social capital assets that you can put to work for somebody else, right? And then you can start saying, right, where do I need to focus my attention? And, better to be focusing on one or two of the right bright spots than thoroughly being disappointed with everybody else.
Kelly, if someone is listening or watching out there and they feel like the ground is shifting, the economy, the job market, everything, what's the first action they should take this week to create momentum?
Well, first, the ground is shifting. The only thing right now I would say to someone is the first shift you should make is with yourself, in the sense of, have you been there for other people? Because if you have been, then they're going to return your call. They're going to answer your email. It's going to be a genuine and authentic, human reaction that they want to help you. But if you haven't been that good colleague, that good coworker, right, then I'd say the one thing to do this week is, you got to think about treating people differently, right? Probably not the answer some people want. They probably just want, hey, here's the email template. But some of the work you need to do, if people aren't responding to you, right? Are you sending the wrong communication, or have you not done the work of being there for other people in the past?
Yeah, sometimes that's the tough love, because that's not blaming other people. That's putting it on you. Mm-hmm. And sometimes you need that introspection.
We don't want to hear it, Andy. We don't want to hear it. We want to hear it's somebody else's fault. I mean, I remember once, and I probably shared this story with you, getting emails from two former colleagues. And there was both direct messages that came in on LinkedIn. And these were people I had not worked with in over a decade. And one of them, it was like getting like a beautiful handwritten note. It was like the digital equivalent of that, of someone who had followed what I'd done. But it was also, I want to say, not only what they said, how they said it brought the rush of emotions back of someone who was just a good colleague. We weren't great friends when we worked together, but it was like everything in their personality from a decade ago when we were interacting on a weekly basis in office corridors came rushing back. And I was like, I'm happy to schedule a call and catch up with you. The other, it was that colleague who was always about him. And you know what? Maybe it's a relief when you decade later and you're like, some things stay the same. Our narcissist, self-centered former colleagues are still narcissist, self-centered professionals.
It's a good reminder, the importance to look in the mirror. Unfortunately, if you are a narcissist, I think looking in the mirror, you still won't realize that there's a problem. You think you look great. Mm-hmm. You're perfect. Mm-hmm. Mm-hmm. Well, Kelly, thank you for sharing with us today. It's always a pleasure to spend time with you.
I'm going to say, when people question the ability to build relationships in a digital world, I dispute it. It's been such a joy getting to know you, Andy, through the number of times I've had the pleasure of being on your show, and I thank you for that. I thank you for the opportunity, and I thank you for your friendship.
Likewise, and thank you for being such a friend of the show and always being willing to drop everything to join us. This has been such a powerful reminder that our networks, they're not something that we have. It's something that you build with intention over time. And because we are in uncertain times, all the time, whether it's stock market, careers, or industries. Your relationships often become the bridge to your next opportunity. So one thing to do after this episode, reach out to one person this week, just one. Not because you need something, but to reconnect, offer value, and simply check in. Just go through that as a practice, because it's a practice that you should be doing all the time. Don't have an agenda. Don't ask for anything. Just strengthen that one relationship. And that's how real networks are built. Thank you again to Kelly Hoey for joining us. You can learn more about her work and follow her at jkellyhoey.co. Make sure that you connect with her and follow her on LinkedIn. And Kelly, congrats on the Social Billionaire. Tell everyone where they should get your book, how they can get sneak peeks into your book, and what kind of things I know that you create a lot of content too, so there must be content around this book release.
I would say so much content, you know what, Andy. Thank you. So the Social Billionaire, there she is. She's a beaut, lovely Tiffany blue. It's available on Amazon. It's available at Barnes & Noble. If you go to bookshop.org, put in the Social Billionaire, you'll be able to find it there. It's in paperback, as you can see, 8.5 by 11. It's a workbook. This you don't get to sit idly by. Grab a pen, grab the book. There you go. And I am on Substack. I also have a newsletter. If you go to my website, jkellyhoey.co, find it all there.
And this is a book for successful women, but I can learn something too.
You know what? As I said, the research was all on high achieving, high potential women, but I really do believe that this is the optimal network structure for those who have big ambitions that they want to take forward. And I also think in terms of conversations I've had with people, when you're a non-majority in a work environment, this is pretty essential in terms of a structure to help you get ahead. Hey, and one of the early reviews of the book on Amazon, the gentleman connected with me on LinkedIn and we had a conversation, and he has read the book, and well, he gave it a 5-star review. So maybe there we go. I would say evidence of one, but it works.
Right on. And I have 2 daughters. I would love to pass the book on to them so that they can learn something and have tools that they can actually apply in real life. So thank you.
And go saying, getting started at this age, that is like the greatest gift, Andy. Do it.
The earlier, the better. Well, thank you for removing our fear from the topic of networking, giving us tools and tactics that we can implement. And thank you, Inspired Money Maker, for joining us for this 90-plus minute episode. Thank you for spending time with us. A special thank you to the Inspired Money team, Bradley John Eaglefeather and Chad Lawrence, for helping to bring this episode together and making these conversations possible. I'm Advisor Andy. Connect with me on LinkedIn. Shout out to all of you who helped me get to 23,000 followers on the platform. Until next time, do something that scares you, because that's where the magic happens. Thank you, everyone.